Hello traders, Gary Wagner here, just about 10:40 in Honolulu, 3:40 in New York. Commodity markets have closed. Equity markets still have about 20 minutes left on the trading day, but we do have an interesting day which is unfolded with oil slipping yet for another day, actually trading below $30 per barrel at one point today, putting some real pressure on the equities markets, which was trading higher during the morning. First to gold, off about $4 on the day, 389, 392 in that area at 1090 and change. Low 83.63, so we're about $7 off the low. The high 99, so we're about $8 off the high. As you can see, trading definitely in mid-range on the day. Silver also trading lower, off about 0.25% at 1381. It's traded to a low of 75 and a high of 92. So definitively trading under $14. And of course, we will absolutely focus on crude oil, which is off about 2.5%, 30.57. But take a look at that low, 29.93. I believe that's the first time it has hit that, I think, since 2002. We'll have to look at some charts during the show, but absolutely a market that has been under dramatic pressure and continues to do just that. So traders, the first chart that I do want to look at today is a simple daily chart, standard candlestick format, and we are looking at spot gold. Currently, as I said, under pressure, trading at 1090 and change. You can see that that's this red candle right here. We've had the last 3 days in gold trade lower ever since hitting this high just the other day. I believe this would be Friday's candle here. The high was 1113. That was the highest that we saw. Now, we pegged interim resistance at around 1118. Now that's a 50% retracement, so that is not that important. And my sense was that if we had a continuation of the rally, we would not have any trouble getting through this area. We certainly did not get a continuation of the rally. And if anything, we talked about the other day that we had this particular candlestick almost really be what we call a shooting star, and that's this candle right in here. The reason it doesn't meet that straightforward classification is the length or size of the actual wicker tail, and that's the distance between the high of the day and the open of the day. On a red candle, of course, the open is the higher of these two parts of a rectangle, closing lower. This would be your close, which would be the bottom of the rectangle. So the fact that we had such a dynamic tail in the marketplace really makes it hard to classify that candle as such. However, what we were able to definitively say is that we were forming a three-river evening star, and we talked about this a little bit yesterday. Today, we did get a confirming candle. Now, on a really strong confirming candle, though, what you want is a long red candle. You want it to close really as near to the low as possibly on the low is the best. In this case, we're closing very much at a midpoint range. And because we're closing at a midpoint range, it doesn't have the same kind of strength that you would get off a call where it closes on the lows. Now, where are we pegging support? We talked about this yesterday, but once again, 1080 has got to be the point. And then you also have this falling moving average. Now, we've got these set at a 50-day cycle, simple moving average, and 200-day. These are our long-term that we really want to view. Of course, anytime the market is trading under the 200-day moving average, you're probably in some sort of a corrective stage, no doubt. Now, the fact of the matter is we broke back above this 50-day, and that was bullish. There's no doubt about it. But we have a real opportunity to see this market kind of drift back into this area. We could see a trade as low as 77 and still find the mark on this particular line. However, the one thing that you want to realize is that with pressure on oil, and a lot of that pressure is oversupply in terms of supply, and when you match it to consumption, we're producing more than we utilize on a daily basis, so stockpiles are absolutely growing. But at the same time, it's dollar strength that you want to be concerned with, because it was J.P. Morgan calling for $20 a barrel oil, and they're basing a lot of that on dollar strength. So that's something we certainly want to be able to watch and to be aware of. So traders, this is a chart we have been looking at almost on a daily basis at this point, because crude oil has had this tremendous drop. Now, if you go back to about 2009, that was prior to the sell-off over the last couple of days, and this is a weekly chart, of course, really the mark that we wanted to see if oil could hold, because really what I said is on the fundamental basis, there's no reason for this fall to stop. But on a technical basis, if there is an area to find at least a bounce in the market, it would be roughly in this area, which is $33 per barrel. Obviously, well below that, trading at $30.44. So as you can see, we have broken dramatically through that particular price point. And the other thing that we talked about when we looked at this chart was that even though it's a weekly chart, these series of lows that come in this area are intra-week lows that occurred at some point and recovered by the end of the week. Now, we've got to go back, I believe, to about 2002 before we see oil at the current price point. So what we've done, this is 30.44. We're simply going to put a line across. It's actually a rectangle, but we'll use it as a thick line. And what we see is that the last time oil is traded at this point was roughly at the end of 2003, beginning of 2004 right here. And from there, of course, it went higher. But we have had a defined break, and a defined break on a technical basis below this particular level, which was 32.33, which puts into question where, in fact, oil could go. As you know, J.P. Morgan and others are calling for $20 a barrel oil. That would put it right here. And the first time that we have seen that price point, you really have to go back to the end of 2001, beginning of 2002. So that's right in here. And that's quite a substantial drop, though, from the price point that we're at. We are going to remain sidelined. If anything, I'm still bearish on the precious metal. There's nothing that's gotten me excited from the bull side. At the same time, if the market does continue to drift lower, we want to see how the market reacts if and when it goes to 1080. So traders, no doubt, an extremely interesting day in the markets overall. We do have the equities markets with about 10 minutes left, now back into solid positive territory, up over 100 points, which is what it was trading at earlier today before trading lower as oil came down and broke below $30 per barrel. Lastly, I do want to take a look at the dollar index, because as we talked about, it is dollar strength that could really put a damper on any kind of upside move, not only in crude oil, but of course in gold. Both of those commodities being factored or priced in US dollars, so very susceptible point-for-point correlation, so to speak. And when we look at this, we've got the dollar, of course, on the top. We have the euro dollar on the bottom. You can see euro dollar over the last couple of days under pressure, breaking below support, which was at, I'll call it 109, so I'm pegging resistance in the euro at 109. And in terms of the dollar itself, 98.90, market's trading at 98.97, so we are just a couple of ticks above what I consider to be a pretty important resistance area. It is a 23% retracement, and of course it is a retracement of just this simple move from about 93.80 up to 100.47 on the index. The breakthrough there and a solid close, we want to look to see the dollar move back up to around 100. Personally, that is what I think it could do. We will have to see. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.